Ladies and gentlemen, our magazine is thrilled to have you all today for its first IR symposium in Warsaw. My name is Candice de Monts, and I am an editor for the magazine. As some of you may know, we have events all over the world, North and South America, Europe, Asia, and we have some fantastic speakers here for you today. So please make the most of the event by asking a lot of questions and engaging in discussions. There will be a short awards presentation after the conference, so we hope you can all stay to enjoy the networking drinks. We would like to thank the Warsaw Stock Exchange for hosting our event, also our official media partner GPW for filming today's conference, and you should be able to watch it on our website in a few days. We also thank the rest of our sponsors, Bloomberg, Capita, Citygate Drew Rogerson, and iPrio. And now, please welcome the Vice President of the Management Board of Warsaw Stock Exchange, Grzegorz Zawada.
Thank you very much. Good morning, ladies and gentlemen. Welcome to the Warsaw Stock Exchange. It's a beautiful day outside, so thank you very much for being here with us today. It means that investor relations and corporate governance are the issues that are close to your hearts. It is a very eventful day on the Warsaw Stock Exchange today due to various reasons, not only this symposium. That's why Paweł Tamborski, our CEO, was not able to attend this morning's session. He sends his apologies and best wishes to all of the participants of today's Congress. We're very pleased to host this event together with the IR magazine. It's the first time ever that this event takes place in Warsaw, which is a good sign that Poland is turning into a financial center for the region, for Central and Eastern Europe, and we're very happy to see that happening. For me personally, it is another great pleasure to be here today and to be able to speak to you, because for the last 15 years I was a stockbroker. I'm an exchange man for a month and a half, and throughout most of my career I was an equity research analyst, so nobody else can appreciate good investor relations and good corporate governance as much as a research analyst. So the dynamic changes that are taking place in today's marketplace make the communication process between investors and corporates an extremely important thing. And according to some of the recent surveys by Bank of New York Mellon, Global Trends in Investor Relations in 2013, this was a survey analyzing IR practices worldwide, is saying that maintaining relationship with investors is at the heart of more than half of all the corporates that are listed in the market globally. And the diversification of the shareholder base is equally important for most of them. So basically, us as a stock exchange, we believe that in today's marketplace, we have to compete with other exchanges for investors' money. And that's why we believe that investor relations and corporate governance are the areas of particular focus. I hope that today's event will be an inspiration for you and will help you in your professional journeys, wherever you come from, whether you're investors or investor relations people. And I hope to see you soon back on the Warsaw Stock Exchange. I wish you a very successful day. Thank you very much.
Now, please welcome Magdalena Polan. She's an executive director at Goldman Sachs and a senior Central and Eastern European economist.
Good morning. Does it work? Thank you. Thanks again. My name is Magdalena Polan. I'm a senior economist in Goldman Sachs Investment Research, where we deal mostly with macro research of the region. Today, I'd like to talk to you about a few things that can be relevant for you, investor relations teams and investors in companies in the region. Global macro outlook, very important for the environment in which we operate. Second, about the emerging markets as an asset class and their progressing transition from being early emerging market to much more emerged or developed emerging markets. Then I would like to look at what happened with the emerging markets in the last decade and how the future, the next decade of emerging market as an asset class may look like. And finally, some changing patterns in trade and also what the benefits of reclassification from EM to DM, to developed market, may be. So let's look first at the global macro outlook. This outlook is fairly positive or fairly benign. It's based on a few assumptions. One is fairly high growth in the United States. US is recovering. The recovery there has happened earlier than in the Eurozone or in Japan, and we think that growth there will exceed the past trends for a while. That should support the global economy. In the Euro area, also progressing but slower adjustment. It took longer for the Euro area to start addressing its problems, therefore it's taking a little bit longer. Still room to grow in the world without inflation pressures, which is a fairly good environment for various assets. Then we also expect the Fed, the US central bank, to hike rates, but rather later. And we also think that once the Fed starts doing it, it will be a fairly steep increase in rates. But for now, we do not expect any change until the end of 2016. We also expect fairly low volatility across various asset classes. We expect solid valuations in DM, developed market equities. Finally, we also expect that there will be some renewed focus on Japan, which could also prove a lesson for many countries, especially in Europe. But we do still see some risks for growth, global growth, and emerging markets growth in China. Now, obviously, that outlook is not without risks. So what are the major risks? Deleveraging. Deleveraging is one of the things that keeps the world from recovering from the crisis. This is an example of a crisis that is one of the worst possible combinations of an asset bust or asset bubble and a financial crisis combined in one. Usually, historical evidence shows that this takes the longest time to recover from. So this can take longer, which means more pressure on the budgets, households, corporate, more retrenchments of corporate and bank balance sheets, so less room to grow. Also, capacity. We expect low inflation, but maybe we are wrong with our estimations of how much companies are investing, expanding their capacity. Maybe we will hit inflation faster, which would mean that interest rates will be rising a little bit faster than expected. Obviously, external risks. We have an example right now on Poland's doorstep, Russia-Ukrainian conflict, slowdown in growth. This creates spillovers, negative spillovers, affects the region, can affect uncertainty about the region among investors. Very difficult risk to deal with and very difficult to predict that type of risks. Also, valuations. Some people are concerned that too many good news already priced in. We may have a quite fast and solid adjustment in valuations, and there could be a large drawdown in asset values. Looking at some numbers, we expect that the major markets, major economies will grow. Despite what you may think right now that there is a slow patch, we do still expect that they would start accelerating in the second half of this year. Therefore, we expect slightly stronger growth for 2014 and 15, 2014 second half, 2015, across a range of developed markets. Overall, as you can see in the bottom of the table, we expect the world as a whole to grow at a solid pace this year and next. Now, why do we still expect that? This is because we think that there is still room left to grow before the world economy comes back to its potential. And that's especially visible in the developed markets, which were hit by the crisis the most. If you look at that dark blue line, this shows the so-called output gap for the developed markets. So this is the difference between what the GDP of a country could be versus what it is now. And you see that gap is quite solid still for the developed markets. It's about 3%. before they even get to where they technically should be or could be without putting pressure on prices, resources, and wages. That gap is smaller in emerging market countries and would be even smaller if we subtracted Russia from that picture. But it still means that you do not hit capacity constraints and you can grow above trend without inflation. Let's now look at somehow more cyclical, high frequency. We quite often look at indicators like PMI, Purchasing Manager Index, which shows you activity in the manufacturing sector. From that, we can derive what growth could be like. And we can see there on the left-hand side panel that this model based on PMI implies stable, not spectacular, but stable, solid growth. The other thing that we look at is so-called global leading indicator. This is something that can tell us what the world economy will be doing a few quarters ahead. And there you can also see that dark blue line, which is the momentum, the acceleration, is actually picking up. And the level of growth is also, the light blue line, is also not bad, suggesting that the global economy is recovering from a softer patch in the second quarter. Now, this is an interesting chart, which we call the swirlogram. My colleague says that it was his cat who inspired the shape. This is something that shows you the combination of the economy, whether the economy is growing or contracting, and whether it's growing faster or slower, or contracting faster or slower. So you as a country, you want to be on the right-hand side of that chart. So you want to grow faster or slower, but ideally you'll be growing faster and faster, obviously. It's not sustainable, but what we can see there is that the August 2014 print shows that the global economy is expanding, not maybe faster than it used to, but it's in that good zone. And there is a possibility that it will slow down the pace of expansion, but it's very unlikely for now that the global economy will move back into recession. And if you look at some major risks, now we ran analysis that shows us 3 factors that can explain global economic performance related to Europe, China, and the United States. You see that the higher the line, the better it is, so less risk. So we see that the risks related to European crisis and US growth are abating, so they are less pronounced. And China remains the key risks to global growth and global economy, but even there we see some improvement in that China-related risks. Now, if we look at the individual countries, let's start with the United States, where we think the fiscal and private sector deleveraging is one of the key drivers of recovering growth in the US. So in the US, you not only had a private balance sheet crisis, house price bust, equity market was overvalued, we had a credit crisis, that led to a retrenchment in private sector balance sheets and activity, but also then fiscal, also things like government shutdown, all affecting the US growth. Now we think that with a more relaxed fiscal stance in the US and private budgets being more solid, this can help the US economy. And you can see the chart shows what we think are these impulses to growth coming from these 2 parts of the economy. And we think these private balance sheets will be supportive, and the fiscal, the public, will not be a drag on growth anymore. The other thing we see is that inflation is picking up. After a crisis, some of that inflation is actually a good sign because it shows that you are brave enough to hike prices because you think that your products can still be bought, and also that you are brave enough to hike salaries. So it's not really a bad sign that inflation is picking up. The other thing is that unemployment rate is falling, and it's actually falling faster than what different forecasts were showing in the past. So that supports also the view that the US economy is expanding. This is also a longer chart showing the US unemployment. Again, it's picking up fast again. And this is the number that the major policymakers in the US, the Fed and so-called dashboard, so the machine that they use to decide on the interest rates, that's the number that goes into that thinking model and that dashboard. And as I mentioned earlier, we expect the US to remain in a fairly accommodative monetary policy stance to scale down the size of monetary stimulus, so the purchases of assets and injection of liquidity into the economy, and wait with interest rate hikes until the end of 2016. So we still have 2 years of very near zero interest rates in the United States. Now, looking at the other major player in the global economy, China. As I said earlier, we do see some of these China-related risks to decline, so to improve, putting less pressure on the world economy. Now, why? Well, first, China exports are picking up. It's a good sign. It's a very strong indicator of global activity, but also a good sign that China is maybe picking up in its competitiveness. Second thing is that there was some monetary tightening in China before, and that economy is very sensitive to these monetary conditions. And the China policymakers in the central bank decided that after all, the economy needed a little bit more monetary stimulus. So if you look at the average interest rates in China, they are getting lower. And for a country that potentially is subject to a credit crisis, this is a very good news, because it makes coming out of a credit boom a bit easier. It's just cheaper to refinance your existing debt. And you see, these interest rates are now back close to their historical lows. The other thing that's happening in China is that the currency, after a long period of appreciation, is weakening, and that makes China exports more competitive. Now, what does it mean for the overall conditions? And we have something that we call the Financial Conditions Index, when we take together interest rates, exchange rates, asset prices, all together. If you put them together there in the other panel, you see that especially that depreciation of the currency is easing those monetary conditions. The lower you go, the easier it is to borrow money or to support growth. And that's happening in China right now, again, supporting our benign view on the global economy right now. Well, we talked a few times about this capacity gap or the output gap, and that leads us to the discussion about inflation, which we expect to stay rather low or close to the targets of the central banks. There are a few reasons why. Well, first is the commodity prices and oil prices. If we look at the oil prices, they've reached a fairly high level and stabilized. You probably remember 2011, 2013 was a period of fairly high fuel prices in Europe, which added to inflation in this region. Right now, oil prices are actually going down, and we expect them to stay flat or maybe even decline. Now, there are a few reasons for that, and some of them relate to capacity and production. And one of the major reasons for that is the so-called Shale Revolution in the US. If you look at the left-hand side panel, it shows you those non-conventional sources of oil production in the world, and a lot of that comes from the shale oil in the US, that gray area. The other thing is that shale oil, despite all the controversies, is much cheaper to produce in the United States. Even at very high capacity and high volumes of production, the break-even price for profitable production of shale oil remains flat and stuck very much at $80, which makes it cheaper to produce regardless of market conditions, which means supply is pretty strong. Now, coming closer to home, Euro area, as I said earlier, we think that the recovery in European Union or Euro area will be progressing, but it will not be as strong as in the US. So if you look at this chart, we expect the economies to grow at a solid pace. So quarter on quarter, they are still expanding, and these are these dark blue bars. And then if you look at the black line, this is the average annual growth rate, which we expect to be fairly solid, but still below long-term averages. If you look at the small table underneath, I show there some of the forecasts we have for the major economies, and there, the healthier economies, like those of Germany, are actually growing at a better pace, which is good news for this region. And those in the south of Europe, those coming out of the crisis, are still lagging, but finally catching up. Now, why do we think that there will be that recovery in the Eurozone? Well, again, fiscal is important. Like it was in the United States, it is even more important in Europe. So again, these are the so-called impulses. So what we think fiscal does to growth. And if you look at the black bars, this was the fiscal impulse in 2012, and then the next one, 2013. So really that very heart of the first phase of coming out of the Eurozone crisis. They put strong drag on growth. Now, if you look at the blue ones, these are the expected fiscal impulses. For many countries, these are still negative, which means that fiscal retrenchment, fiscal austerity is still negative for growth. One big exception, Germany. Also some of the countries in Northern Europe which didn't have to cut their debt, didn't have to cut their budget deficits, they don't have that negative impulse. Again, very good news for Central Europe, which is heavily integrated with these countries. Now, these fiscal impulses may be becoming less negative, doesn't mean that fiscal austerity is ending. Because if you try to calculate how much countries need to cut their deficits to stabilize their debt, and let's say stabilize them at about 60% of GDP over a longer time, you still see that the blue one shows you how much fiscal cuts have been already completed. And the gray one shows you how much there is still left to do. And the only country, again, of the big European countries is Germany, which actually doesn't need any more fiscal austerity. The other countries are still stuck and have to deliver if they really want to stabilize their public debt. Obviously, growth matters as well, and this is calculated assuming some trend growth. If growth is better, they have to do less fiscal adjustment. If growth is lower, there's more adjustment left, more pain for the European economies. But there are some things that are supporting recovery as well, not only fiscal. The other thing is interest rates. Interest rates are declining across Europe, finally, especially in those countries in the European periphery. There is still, though, this huge disconnect between interest rates in a country that has the same currency. North has lower interest rates than the South, and these markets appear to be disjointed. So the currency area as such doesn't function in this particular area. However, we see that finally interest rates in the peripheral countries are also declining, which means that, again, that financial condition index that we use to combining exchange rates, interest rates, asset prices, it's also easing in the peripheral countries. So again, bottom line, again, not a surprise, Northern European countries and France with less crisis. On the top, Italy and Spain. Even there, you see finally these years of adjustment are starting to pay off. Another thing that lots of people are concerned right now about Europe, and also here in Poland, is the risk of deflation. So prices declining. Why is that bad? Well, Eurozone is recovering from a debt crisis. The lower the prices go, the higher your debt is in real terms. You want to have some inflation to erode that debt. So the risk is still there. If you look at some of the forecasts, it seems that we are now at the bottom of that inflationary cycle. And inflation should be recovering, still nothing high. So there will be no inflation erosion of debt, but it should be helping a little bit. If you look what's priced in the market, so not only our expectations, but the market, you see these are different inflation expectations derived from different assets, especially swaps, which need to take into account expected inflation when you price them. And there you see that they also point to short-term deflation risks, and that's that gray line, because that's the shortest dated instrument that prices it, versus the longest dated instruments that price fairly flat inflation close to the ECB target. What does that mean? That means that even though the European Central Bank may take additional actions to stimulate the economy, it doesn't really have to do anything extraordinary to fight deflation like you had, say, in Japan, when you had to print money, weaken the currency, do whatever it takes to avoid that risk. Well, there are a few more reasons why inflation is low, not only oil, and not only the fact that economies are operating below potential. The other thing is that Europe is adjusting, and some of the countries are cutting their labor costs, and that means lower production costs. They're not very successful at that. Spain appears the most successful country, and if you look at that gray line showing Spain, their unit labor costs, so how much you pay a worker for a unit of output they produce, there they have gone down. But if you look and compare them still with what's happening in Germany, these countries have, these are not levels, these are indices. So it doesn't mean that it's more expensive to hire a person in Spain or Portugal. It means that their costs since 2000 increased by about 30%. So it's 30% more expensive to produce output in Spain or in France or in Italy than it was 14 years ago. If you look at Germany, until last year, it was only 10%. Right? So relatively speaking, the German economy is still gaining competitiveness over the southern countries or over France, despite them still doing a lot of austerity, reforms, having high unemployment, which means that the challenges of the European reforms are still fairly high. Now coming to the emerging market countries, again, we look at the PMIs, they show that they are a bit weaker right now in the emerging market countries than they are in the developed economies. Still, they are pointing towards growth in the EMs. And again, a quick look at this financial condition index, it remains fairly flat. Looking at the assets, these are the charts showing some equity performance. On the left-hand side, EM equities are underperforming a little bit the developed markets, but they are showing some turnaround. But if you look at the currencies, well, they appear overvalued against the dollar, in part because the dollar is undervalued too. But it's very difficult for these currencies to repeat such a strong run they had until now. Interest rates in emerging markets, though, are still declining, in part because of low inflation as well, because of the repricing of growth expectations, low interest rates globally, so EM interest rates are also lower. And also the cost of borrowing, so sovereign risk, CDS, these are also still lower. But if we look at more longer-term growth, well, if we take into account our forecasts, the differential between emerging market growth and the developed markets is narrowing and will narrow a bit further, making the region a little bit less attractive over time. Looking at CEEMEA, again, we're coming back to those indicators that I mentioned before. This time we'll look at the current activity indicator. It's kind of a, what you call these days the nowcasting, not the forecasting, but nowcasting. So trying to see what growth is in real time. It has slowed down a bit in our region, but it's mostly because of Russia. If we exclude Russia, which we can see on the right-hand side, it actually is doing pretty well. And Poland especially is a part of that solid performance. Again, the leading indicator, the one that lets us look forward with seeing how the economies are doing, again, fairly decent outlook, in part thanks to the decline in that financial condition index, so making things easier monetarily to borrow, to refinance, and the leader here is Hungary. Hungary, which cut rates by almost 500 basis points, and on top of that injected large amounts of liquidity into the local economy. A number of forecasts, we can probably see them later. Anyway, they point to sustained, maybe slightly slower growth in next year, but still fairly positive. The other thing is also low inflation. No need to study the table, you can see them later in the handouts. Overall, we expect inflation to stay very low, not negative, but very much below the targets. And that means that here in Central Europe and CEEMEA, central banks have very little reason to hike rates, exactly as they don't in the US or in the Eurozone. Now let's look at something that is much more structural, can be of more interest when we look into the future of the emerging markets as an asset class, and they transition into the developed markets. So emerging markets are becoming a larger and larger part of the global economy. If you look at who are the biggest players in the global economy, United States, China, Euro area, but then you see India, Brazil, Russia, Mexico, even Poland is the 16th largest economy right now. They are becoming a much more important element of what happens and also what affects the most developed markets. If you then look at what does it mean? As they grow fast, they have a profound impact on what the world wants, what are the consumption patterns, what are the global trade patterns. For example, this is the size of countries. It shows you at what time different emerging market countries are exceeding in size developed market economies. So BRICS, these are the Brazil, Russia, India, China, and individual countries of these largest countries, you see that they have long time ago exceeded China especially, the size of the major developed markets. Even German economy is on the way to being overtaken by a number of emerging market countries and the US as well. And should these economies continue to grow at a solid pace they are doing now, they'll exceed the whole size of G7 at around 2035, which when you think about it, it's 20 years from now. People start discounting these things at a certain moment. What does it mean also for the trade patterns and growth patterns? You have demand from these countries for commodities, which exceeds demand from the developed markets. Also, the demand for durable goods is already higher in emerging market countries, so especially the everyday durable goods that you need in a home. Higher end, where we are already well on the way for the emerging markets to exceed global demand for these goods coming from developed markets. And finally, luxury products. Pretty much there, we're also moving within the emerging markets to exceed that demand. And if you look at some studies on showing what people want as they become richer, these are the typical categories. And per capita income, well, depending how you measure, whether this is PPP, so purchasing power adjustment or nominal, well, people want better and better things. And we are moving away from wanting fridges and wanting meat to rather our holidays in Tahiti and having a Porsche, right? So this whole emerging market universe is moving slowly towards those patterns. Maybe not everybody will obviously have that Porsche, but the whole trading and consumption pattern in the world is shifting. Now, why is that changing? What is helping these markets to move? Well, we look at something which we call the growth environment scores. And these are the multivariable measures of what drives growth and what helps growth. And if you look at the trend, they have improved a lot for emerging market countries in the last, say, 17 years, since the time the GS research team started measuring it. And one of the larger improvers is Central Eastern Europe, which combined the transition of coming out from communism into market economies together with the convergence towards the European Union, which helped improve various growth conditions like institutional quality, education, health, human capital, technology. All of that is helping these regions to improve the seeds of growth. And when you see what is driving that growth, well, look at the left side. This is just last year, so it's not a long term. But if you look at last year only, EMs had huge improvement in technology, also in the so-called microenvironment, which is regulation, and also human capital. Education, ease of doing business, friendliness of the administration helps a lot for these countries to grow. However, the pace is easing. So even though the most successful gainers like Central Eastern Europe, they are not converging to the quality in the developed markets as fast anymore. It's not a surprising thing because the more developed you are, the more difficult it gets. But the risk is obviously that countries get stuck, and they get stuck in that middle income trap. So even though Central Europe has been the highest, the strongest improver of them all, there remains that challenge for the region. And look at the others. Over the last, let's go back. Over the last year, the developed markets, no improvement, mostly because they're dealing mostly with the crisis. North America actually worsening. Developed Europe worsening. Latin countries quite worsening in those growth conditions. If we then look at the whole period since 97, again, North America, developed Europe saw least improvement, which is, well, again, not that easy to gain on, well, once you are a highly developed, efficient economy. Now, talking more about trading and demand for emerging market assets. So we had that structural part of change in the emerging market assets. Let's now look at the last 10 years and what may happen in the next 5-10 years in the emerging market countries. Now, this is what we call, these are not your older brother emerging market countries. You are used to those volatile, unstable places with high interest rates, high returns. Stock exchange in Warsaw delivering, what was the highest return? Say 20% every year? That's not going to happen probably anymore. Let's see now first what were the drivers of that very solid performance in this previous 10 years. Well, there was this big impulse coming from China. China was delivering goods cheaply, adding to a global growth. Then we had declining inflation. Inflation finally stopped being a problem. We had decline in interest rates abroad, which meant investors were looking for more opportunities in the emerging market countries. Then we had decline in debt. So remember 97 crisis, remember the Russia crisis 98, then Argentina crisis. These became things of the past. The debt crisis now a problem for developed economies, not emerging market countries. There was also increase in commodity prices, which helped those countries that are commodity exporters. And also, this was kind of a virtuous cycle of these factors mutually reinforcing each other. But things look a little bit different when we look at the next 5-10 years. Why is it so? Because that impulse from China is waning. So China is still a solid performer, but it's not growing as fast as it used to. The other thing is that inflation cannot come lower anymore. In Poland, last month, it was minus 0.3%. We cannot have lower inflation anymore. It will be deflationary environment. So that benefit from declining inflation is also gone. Interest rates in the United States are moving higher after the decline that was triggered by the crisis. Then we have the improvement in external balance sheets, or what we call the external debt. So debt you owe in foreign currencies, which is now much lower for emerging market countries, or to foreigners. It's also difficult to bring it any lower. Finally, the long trend in commodity prices is also probably over, which is good for countries like Central Europe, but probably not very good for commodity exporters like Brazil, Chile, Russia, or even countries like Australia. So this poses some risks. These countries have to adjust to higher United States rates in the US and eventually in Europe. They have some risk of bumpy ride as markets adjust. They hear the US central bank saying, one day I may possibly hike interest rates. And then you had a massive sell-off in emerging market countries just as the markets thought about that. So that is a bumpy ride that may expect some markets. And also, of course, then you have the risk of negative feedback loops, as you had the benefit of positive loops in the past. But overall, emerging markets are in a better position than they were even in 2008. So, especially countries that didn't waste that time and addressed the problems. So, differentiating between emerging market countries becomes more and more important. They are not a class of assets anymore. You cannot look at them. You cannot even look at the region of CEE region as one, of Central Europe. Investors need to look, and they increasingly do, look at these countries as individual countries. And they slowly start to treat them as if they were in a separate asset class. So they look at growth, they look at the quality of policies, things that we describe in that global environment scores. they watch out for individual economic variables, current account deficits, inflation, more and more on the individual country level. And quite often when I talk to investors, they start treating some of the emerging market countries as developed markets. Some of these countries are already past that benchmark. For example, Czech Republic has already passed the income threshold that qualifies them as an advanced economy. It's a certain benefit for that country because it opens a much larger pool of investors, but at the same time, its weight in the developed market index is tiny. So Poland, for example, has a very high weight in emerging market indices. For that indices, it actually has to be capped at 10%, otherwise it would have been higher. If it moves to a developed market index, it will open a huge pool of capital, but its weight will be much tinier. So it can be a beneficial thing, more money coming in your way, but if you think about indexing investors, they can actually see you as a small player. However, that transition is happening, and quite often when I talk to investors, they say, especially for Poland and other countries, I love Poland. Poland is boring. Boring is good. So you definitely want to operate in a country that in this way is boring, because that means you have much more stable investor base. People often laugh at the proverbial dentist who buys your bonds, but probably this dentist is the best investor you can have. So let's just look at a few charts that illustrate the point that the emerging markets are in a different world right now. Commodity prices, stable or declining. Good for the developed EMs. We buy our oil cheaper. Pretty bad for commodity exporters. Now, that growth impulse coming from China. Again, long-term growth projections of growth from China are declining. The contribution to the global growth is declining as well. In part, why? Well, it's kind of a developed market sin because they're having more and more debt, and they have to deal with it before it blows up. The other thing is that, well, some of the countries decrease their debt levels, but some actually have a bit of a constraint on the growth coming from that. And within our region, this is particularly Hungary, Poland, Czech is still in the middle of the pack, but very, very far away yet from the average debt levels for the developed economies. So debt is not a constraint yet on how much these countries can expand the financial sector and borrow, but slowly for some countries may become an issue. Then if you think, we had this big change after 2008, especially in the US, when interest rates were cut to zero, where different asset classes in the US benefited a lot. If you look at those light bars, especially for the US, credit has suffered there. Real trade-weighted exchange rate, so the US dollar has suffered. At the same time, emerging market currencies benefited a lot, and emerging market credit benefited a lot. Now, as we have a reversal in US policies, higher rates, higher growth, these bars will probably reverse too, which means more pressure on these particular asset classes. And also, not everybody benefits as much from growth in developed markets, especially in the US, when you think about it, where you export your goods. Well, some countries export a lot of goods to US and will benefit from that, but that's mostly Mexico, Israel, Thailand, Korea. Other countries actually export a lot to other emerging market countries. So while there is still growth about that EM to EM trade, if the US is going to grow faster, the EM countries are not going to benefit as much from it. However, the more developed EMs, like, for example, Central Europe, is uniquely positioned to benefit from recovery in the Eurozone. So if you think, these are kind of charts that show you how much of our GDP is embedded in the demand coming from different countries. And for the region, here, overwhelmingly, this is an exposure to the Eurozone. If you think about that, 18% or even 18% of Czech or Hungarian GDP is exposed to demand in the Eurozone. And we are here correcting for things like Czech car producer gets car parts, produces a Volkswagen, and then sells the Volkswagen back to Germany. We correct for that. So that's excluded. It's really the final demand coming from these countries. And it's a huge share. So these are uniquely positioned to develop what happens in the developed markets much more than what happens in the other emerging market countries. Let's skip that. And you see, with those interest rates increasing in the United States, while interest rates in the emerging market countries are picking up already too. So the attractiveness of those assets, has to increase the more US rates increase. Still, the differential between interest rates in these regions is narrowing down, making emerging markets less attractive. Again, what matters here is if you look good, it becomes a beauty contest. You have to look good on different risk metrics, on different vulnerability metrics, and also those environment variables like, do you have good institutions? Do you have good policies? Is your policy credible to keep my money in as everybody is taking money out from other emerging market countries? Now, also, if you look at where valuations are, it looks like some of the asset classes in emerging markets still seem a little bit undervalued. For example, equities, maybe FX, but others like credit, so external debt, corporate and sovereign, and especially fixed income, some bonds, seem to be already overvalued. So as the world adjusts to the new environment of the developed markets coming out of the crisis, some of the assets may suffer. Well, it's the good news for the Central Eastern European region here because they benefit from the so-called ECB offset. So if you think about what happens in different assets in emerging market countries where the Fed increases its rates, well, that dark bar on the left-hand side shows you the reaction. Now, if the ECB was to lower its rates or increase its stimulus, well, it could offset that effect. So your market doesn't have to suffer from the Fed that much if you're close to the ECB, which is exactly where this region is. So it benefits from that ECB offset, and also it benefits from the fact that it's increasingly being seen as a developed economy much less sensitive to those external interest rate risks. So, as I said earlier, investors are differentiating more and more. They're looking more and more at signs of imbalances, so weak growth combined with high inflation, current account deficits, and policy quality. And we have a few countries where investors are concerned about that. A case in point this year was Turkey, where the central bank had to hike interest rates by 400 basis points just to support the currency. Then earlier, 2013, there was the countries what were called the Fragile Five, that also included Indonesia, India, Brazil. However, if you look at the region here, solid growth, low inflation, improvement current account balances, and as you saw, quite good quality of growth conditions, those growth environment scores. So, as the emerging markets change and move into that more developed status, at the same time, you have that change in the developed market economies. You have the vulnerability of some of them, but you also have the benefits from the transition. And the more developed you get, the less sensitive you become. Now, I can finish here if you have more questions. If you have any questions on what I said so far, I also have a few charts given to me by my colleagues from the strategy team, which I can show you. Now, this reflects to equity market long-term perspectives in emerging market economies. So, overall, as the global markets, the emerging markets constitute a still fairly small share of global market valuations. However, if these economies continue to grow, they may exceed actually half of market capitalization by 2030. Remember, that was the time when we also thought that the share of these countries in the global economy will exceed those of the G7. So that's a very good news for the asset class. The other thing for the emerging market countries and the potential shift into developed market is how little actually is invested in emerging market equities. So the traditional developed market managers, they held just above 6% of the assets in emerging market funds. So if you get reclassified towards DM, you open a huge pool of capital available to you. At the same time, you don't even have to be reclassified. If investors are looking for a return and they consider developed market equity as being highly valued or maybe overvalued, EMs are still a very interesting asset class to buy. Now, a little bit more statistics. Who holds emerging markets assets? From which sources? You see that a lot of investors come from United States. Again, a large investment pool available to invest in the EMs. And you have mutual funds, predominantly pension funds, and then ETFs, so exchange-traded funds. I think if we will look at the latest data, which will be available sometime later, ETFs will probably be a more important group of investors. And then you also have Europe, which is split much more between the more traditional mutual funds and pension funds. Now, my colleagues from the strategy team predict that there will be a large increase in the EM equity holdings, and part of that is just growth of the current holdings, valuation effects, the economies expanding, and then additional one coming from inflows, which is much smaller. So they still expect that the organic growth of the asset class and the economies will be the major driver. Again, having better growth environment scores, having better institutional quality, having better policy view can help markets attract a little bit more of that smaller pie of the future inflows. And finally, domestically, the interest in the equity market, well, is still small. This is mostly because the savings available to invest into equities in emerging market countries are not that big. Well, if you remember, people are still busy buying some of the consumer goods they want to have a better quality life. It's only the next stage of your development, that part when you are considered that DEM of EM, where you think about savings and your future and investing in equities much more. So if you look at the institutional funds in emerging markets, they are still in an early stage of their development. And they own smaller part of the overall market in these countries. Now, a final chart for today. Now, this is the relative performance of EM equity versus developed market equities and the relative growth of these two groups of countries. Now you see there is a very strong correlation, obviously. The stronger the emerging market grows against the developed markets, the stronger the equity market performs. Now, as I showed you earlier, that growth differential is narrowing, so that advantage of the EMs over DMs is also declining. Again, for markets that want to capture that slice of pie of the inflows, the better the institutional quality, the better or the more you're perceived as being a DM or maybe even reclassified, the better it is for the performance of these markets. Thank you, and do you have any questions?
Thank you, Magdalena, for such an insightful presentation. I'd like to invite questions from the floor.
Otherwise, we can have questions during the coffee break.
Yeah, as well. We have Peter over there.
Hi, yeah, Peter Niklovich from the Warsaw Stock Exchange. Thank you, Magdalena, for a great insight into the world of emerging markets. Just really one question regarding emerging markets into developed markets. So, because you talked about, I guess it could be a good thing to be reclassified, or it could be a bad thing. We also learned about the importance of dentists, so thank you for that. If you had to say one way or the other, is it a good thing or is it a bad thing? For me, the chief executive of a CEE PLC, which way would you go?
I think it depends much more on the fact whether you're called DM or EM, right? So you can be called a developed market economy, but if your growth outlook is bad, if your investor protection rules are not very good, then it doesn't help you at all. So it's not a panacea for your problems. You have to have all the hard work done before you can actually reap the benefits. Of course, there's some kind of a lazy flows always coming to countries because of the benchmarking. But again, if you're an EM, you're probably a larger share of that benchmark than if you were a DM. So it's a bigger pie, but it's a more competitive pie. So I think for any company, it's still the quality of its own business that will matter the most.
Hi, my name is Melis Öztürk from Garanti Bank in Turkey. Thank you very much for the presentation. It was very insightful. In the presentation, you mentioned that you are not expecting any interest rate hike from Fed until the end of 2016. Yep. And nowadays, you know that more and more analysts and economists expect, as early as the first half of 2015. What are your reasons behind this expectation?
So let's just go back because we actually have the expectations of the others. There we go. So the view of our US team is that actually the United States Fed does not want to tighten its policies too early. There are other things. First, scaling back of the asset purchases by the Fed is already a form of withdrawal of that monetary stimulus. So the moment you stop injecting liquidity, you stop your further easing, so the expansion of the monetary base. That's one step. The other thing is that the central bank does appear a bit dovish. Inflation is picking up, but inflation risks are not very pronounced. And also, the view of our US team is that the central bank would like to see that it is not too early. It's not killing the recovery before it can move on. So I think in this way, probably the Fed has learned the lessons from Japan a little bit more than what the market is currently pricing in the different assets that would then indicate a faster increase in the interest rates in the US. So caution, I guess, is the one word to answer.
Thank you.
Any more questions? No? Are you all eager to have a coffee now? Is that why?
Well, thank you very much.
Thank you so much, Magdalena. Now we're going to have a short coffee break. You know where it is. And resume in a half an hour.